Hello, everyone. 10 days. That's all that's left before the global silver market changes forever. On January 1st, 2026, China will flip a switch that Wall Street has spent decades trying to keep hidden. A switch that will expose the largest precious metals manipulation in modern history. And at the center of this trap sits JP Morgan Chase, holding a $22 billion position they can't exit, can't hedge, and can't survive. This isn't speculation, this isn't a conspiracy, this is documented reality, and the countdown has already begun. While you've been watching silver climb to $67 per ounce and celebrating what looks like a normal bull market, something far more calculated has been unfolding behind the scenes. China, the nation that controls 60 to 70% of the world's tradable silver supply, just announced export licensing requirements that take effect in exactly 10 days. Not a suggestion, not a gradual policy shift. A hard deadline that will require government approval for every single ounce of silver leaving Chinese borders. Think about what that means for a moment. The world's largest supplier of silver is about to turn off the tap. And JP Morgan Chase, the biggest bank in America, is standing directly under that faucet with their mouth wide open, desperately trying to catch enough metal to cover a debt they should never have taken on in the first place. Understand how we got here. You need to understand how the silver market actually works versus how you think it works. When you hear about silver trading on exchanges like the COMEX in New York or the London Bullion Market Association, you probably imagine physical bars of metal changing hands, right? Shiny ingots moving from vault to vault as buyers and sellers settle their transactions. But here's what should make you sit up and pay attention. According to decades of exchange data, 95% of all silver futures contracts settle in cash, not metal. Cash. Let me repeat that for emphasis. 90. That means for every 100 paper contracts promising silver delivery, only 5 people actually demand the physical bars. The other 95 just take their profit or loss in dollars and walk away. They never wanted the metal. They wanted exposure to price movements. They wanted to speculate. And that simple statistical reality created the most exploitable loophole in modern finance. Because if only 5 out of every contracts need real metal, then mathematically you could sell them 100 paper promises backed by just 5 ounces of actual silver sitting in a warehouse somewhere. It's the same principle as fractional reserve banking applied to precious metals. You promise delivery to everyone, knowing statistically that almost nobody will actually show up to collect. And for decades, this worked flawlessly. The banks running these exchanges got rich. The shorts made fortunes betting against price increases, and retail investors, the ones who actually believed in physical silver, got crushed every time prices started to rise because the exchanges would simply create more paper contracts, flood the market, drive prices back down. But fractional reserve systems all share one fatal weakness. They collapse the moment people lose faith and demand what they're owed. And right now it's $67 per ounce, with China about to cut off supply and industrial demand hitting all-time highs. Faith in the paper silver market is evaporating faster than water in the desert. JP Morgan didn't just participate in this system, they engineered it. Between 2008 and 2020, they accumulated short positions so massive that they controlled 32% of the entire COMEX silver market at their peak. One single bank, 1/3 of all short positions in American silver futures. Think about the audacity required to take that position. The absolute certainty that you control the game so completely that you can bet against nearly 1 billion ounces of silver and never face consequences. In March 2020, their position peaked at 40. That represents 20 million ounces of silver they had promised to deliver if called upon. To put that in perspective, that's more silver than most mining companies produce in 5 years. And here's the part that should make your blood boil. The CFTC, the Commodity Futures Trading Commission, has position limit rules specifically designed to prevent exactly this scenario. The limit for silver is 9,000 contracts. So how did JP Morgan hold 40,050 contracts, which is 4 CA half times the legal limit? They claimed an exemption. According to their regulatory filings, all those short positions were classified as hedging activity for their vault operations and banking services. You're allowed to break position limits if you claim you're hedging legitimate business risk. But if you're running vaults specifically to facilitate manipulation, and then using those vault operations as justification for unlimited position sizing, you've created a perfectly circular scheme. It's like owning a casino, loading the dice, and then claiming your gambling is just hedging your casino business risk. The regulators bought this excuse for 14 years, but the evidence didn't stay hidden forever. In September 2020, JP Morgan agreed to pay $920 million to settle charges with the Department of Justice and the CFTC. The charge spoofing, that's the practice of placing large fake orders on exchanges to manipulate prices, then canceling those orders before execution. According to the DOJ investigation, JP Morgan traders placed thousands of spoofing orders in precious metals markets between 2008 and 2016, creating false impressions of supply and demand to move prices in their favor. $9 and $20 million. That's the largest precious metals manipulation fine in American history. And here's the part that should enrage you. JP Morgan didn't have to admit wrongdoing. They paid the fine, released a statement about improving their controls, and kept their massive short position completely intact. The underlying manipulation, the concentrated position that gave them market control, was never addressed. They paid what amounts to a cost of doing business and continued the same strategy for another 4 years. But something changed in 2025, something that forced JP Morgan to do the unthinkable. Between June and October 2025, JP Morgan exited their entire 200 million ounce paper short position in silver futures. Not gradually, not quietly. They liquidated the whole thing in 4 months. For the first time in over a decade, JP Morgan Chase went from being the biggest short in the silver market to being completely neutral on paper. And then they did something even more extraordinary. They started buying physical silver aggressively, desperately, like a man who just realized the building he's standing in is about to collapse. By December 2025, JP Morgan's physical silver holdings reached over 750 million ounces. That's the largest private stockpile of silver in recorded history, 750 million ounces. That's nearly equivalent to the entire world's annual mine production. In just 6 weeks leading up to early December, they added another 21 million ounces to their hoard. At current prices, around $67 per ounce, we're talking about a position worth over $50 billion. But here's where the story gets really interesting, because JP Morgan didn't accumulate all that silver because they suddenly became silver bulls. They accumulated it because they're trapped. And the trap was set by their own greed, combined with a decision made halfway around the world, Beijing. In October 2025, JP Morgan faced a crisis in London. The London Bullion Market Association, the LBMA, is where the world's physical precious metals actually trade, not paper contracts. Real bars of silver weighing 1,000 troy ounces each, stamped with refiner marks and serial numbers, sitting in vaults underneath the streets of London. And in October, JP Morgan couldn't deliver. Demand for physical silver had overwhelmed their available inventory. Industrial users were demanding delivery. Asian buyers were pulling. Middle East and JP Morgan's vaults were running dangerously low. So they did what any desperate entity does when they're about to default. They borrowed. They went to the Industrial and Commercial Bank of China, ICBC, China's largest bank and a major player in precious metals, and they leased 4,000 metric tons of physical silver. That's approximately 6 million ounces. At current prices, we're talking about 7 to 9 billion worth of metal. But here's the critical detail that creates the trap. Lease term is 3 months. The silver must be returned by early January 2026, and it must be returned in physical silver, not cash. Think about what that means. JP Morgan borrowed 128 million ounces of silver to cover delivery failures in October. They have to give it back in less than 2 weeks. And to return it, they need to source physical metal from a global market that's already in deficit. A market where industrial demand outpaces supply, a market where vaults are being drained, and most importantly, a market where the world's largest supplier is about to shut off exports. China's Ministry of Commerce and OAFOM issued a policy update at the end of October 20. Most people missed because it was buried in administrative language about export quotas. Effective January 1st, 2026, all silver exports from China require government-issued licenses. This isn't a quota system where there's a fixed amount available and first come, first served. This is a discretionary approval system where the Chinese government decides who gets to export silver and who doesn't. The stated eligibility criteria are revealing. Only large state-certified companies producing at least 80 tons annually can even apply for licenses. Smaller exporters are completely shut out. The approval process is controlled by MOFCOM bureaucrats who answer to the Chinese Communist Party, and the scope extends through 2027. Meaning this isn't a temporary measure. This is a structural change in how China manages its most strategic resources. Now, China frames this as protecting national resources amid domestic shortages, and that's partially true. China's solar panel industry consumed approximately 150 to 70 million ounces of silver in 2025. Their electric vehicle sector consumed another 30 to 50 million ounces. Combined, China's domestic industrial demand for silver approaches 25 to 30% of the entire world's annual mine production, and they're building more solar capacity, more EV factories, more electronics manufacturing. Internal demand is accelerating while global supply remains flat. But there's a more calculated strategic dimension to this policy. China has been on the receiving end of Western export controls for years. Semiconductors, advanced manufacturing equipment, artificial intelligence chips. The United States and its allies have systematically tried to limit China's access to cutting-edge technology, and China just responded by doing the same thing with a commodity that the Western world desperately needs, but cannot easily replace. Silver isn't just a monetary metal. It's the most electrically conductive element on Earth. You can't build solar panels without it. You can't manufacture advanced electronics without it. You can't produce electric vehicle batteries without it. And China just put a chokehold on 60 to 70% of the world's supply. But here's where it becomes a kill switch for JP Morgan specifically. To return the leased silver to ICBC, JP Morgan needs to source 128 million ounces of physical metal. If their holdings are sitting in London or New York vaults, they need to physically ship it to China. But even if they wanted to do that, the new export licensing rules create a bureaucratic nightmare. More critically, if they need to buy replacement silver from the global market to maintain their other positions, they can't easily access Chinese sources anymore. The world's largest supplier just became unavailable for spot purchases without government approval. This creates what traders call a physical default trap. JP Morgan can't readily source the metal they need to fulfill their obligations. If they fail to return the silver to ICBC, they're in breach of contract. If they try to buy 28 million ounces on the open market in 2 weeks, they'll drive prices through the roof, potentially triggering a short squeeze that destroys whatever is left of the paper market. And if they pull from their existing 750 million ounce hoard, they admit that hoard isn't backing other positions, which triggers more delivery demands from contract holders who realize that backing isn't really there. Every option leads to the same place: exposure, default, or explosive price increases. They built a system based on the assumption that physical delivery would remain rare. They accumulated short positions based on the certainty that they controlled the supply chains. And now they're discovering that assumptions and certainty mean nothing when the rules change and the supply gets cut off. But the trap gets even deeper, because while China's export controls are squeezing supply from the East, another policy change is about to remove liquidity from the West. The London Bullion Market Association, remember them? They set the standards for what counts as good delivery silver in global markets. If a bar doesn't meet LBMA standards, it can't be easily traded in London, which means it can't be easily traded anywhere in the Western financial system. On December 16, 2025, 5 days ago, the LBMA announced rule changes effective January 1st, 2026. Buried in those updates is a provision that prohibits non-Roman lettering and serial numbers, date stamps, and thinness markings on silver bars. Non-Roman lettering, that means Cyrillic characters. That means bars produced by Russian refiners. Now you might be thinking, so what? Russia's refiners were suspended after the invasion of Ukraine. Anyway, but here's the critical detail. Bars that were produced before the 2022 suspension, bars that currently sit in vaults and count as good delivery inventory, those bars have Cyrillic serial numbers. And the LBMA's new rule doesn't explicitly grandfather existing inventory the way they did for other technical specifications. This creates an ambiguity that could remove 200 to 300 million ounces of silver from tradable inventory overnight. If vault operators and traders interpret the rules strictly, any bar with Cyrillic markings could be rejected for settlement starting January 1st. Those bars wouldn't become worthless. but they would lose their good delivery status, which means they trade at a discount, require re-certification, or need to be remelted and restamped, all of which takes time, costs money, and removes that metal from immediately available supply. Think about the timing. China cuts off 60 to 70% of new supply through export licensing. The LBMA potentially removes 200 to 300 million ounces of existing inventory through a technical rule change. Both policies take effect on the exact same day, January. In 10 days, if you wanted to engineer a supply crisis, if you wanted to create conditions for a massive short squeeze. If you wanted to break the paper silver market and force a reset to physical pricing, you couldn't design a better scenario. And JP Morgan Chase is standing at the epicenter of all three pressure points. Let's talk about the mathematics, because this is where speculation ends and cold hard numbers take over. As of today, December 21st, 2022, total COMEX registered silver inventory stands at approximately 50 million ounces. That's the metal that's actually allocated and available for immediate delivery. There's another 86 million ounces sitting in eligible inventory, which means it's in COMEX warehouses, but not designated for delivery. Think of registered as ready to ship, and eligible is in storage but spoken for. Now, total open interest across all COMEX silver contracts represents 862 million ounces of paper claims. That's 862 million ounces that contract holders have the legal right to demand as physical delivery. So we have 50 million ounces available to deliver against million ounces of promises. That's a ratio of more than 17 to 1 to 1. 17 paper claims for every single physical ounce actually sitting in deliverable form. The system has survived because historically only 5% of contracts demand physical delivery. But let's run a simple calculation that shows why $67 per ounce broke that assumption permanently. What happens if just 6% of open interest demands physical delivery instead of the historical 5%? Just 1 percentage point higher. 6% of 60 million ounces equals 7 million ounces. Available registered inventory equals 50 million ounces. We're already in deficit territory with just a 1% increase in delivery demands. That's how thin the margin is. The system has no buffer left. And remember what happened in late November 2025. During a single delivery period, 36.7 million ounces in delivery notices hit the exchange. JP Morgan had to reclassify 13.4 million ounces from registered to eligible status, removing it from deliverable inventory during what they claimed was a CME server outage. Market participants didn't buy the excuse. They saw it for what it was. JP Morgan protecting the remaining inventory rather than making it available for delivery. If delivery demands continue at November rates, and remember, this is before China's export controls take effect, before the LBMA Cyrillic ban potentially removes Russian bars, before industrial panic buying accelerates. At November rates alone, the entire registered inventory gets depleted in approximately 3 months. We're looking at March 2026 as a mathematical endpoint where the deliverable silver simply runs out. But here's where it gets even more dire. Delivery demands don't stay constant when inventory depletes. They accelerate because once market participants realize that inventory is dropping faster than it can be replenished, the rational response is to demand delivery immediately before the vaults are empty. It's a bank run, except the bank is a vault and the deposits are silver bars. If delivery demands increase to just 60 million ounces per month, which is entirely reasonable once panic sets in and China's export controls take effect, you're looking at less than 1 month before registered inventory is exhausted. And here's the trap within the trap. JP Morgan can't pull from eligible inventory to replenish registered without triggering exactly the death spiral they're trying to avoid. Every ounce they move from eligible to registered is an ounce they're admitting isn't backing some other paper position, which proves the fractional reserve game, which triggers more delivery demands from contract holders who realize the backing isn't there. Now, you might be wondering whether new supply could rescue this situation. Maybe miners ramp up production. Maybe recycling increases. Maybe inventory flows in from other sources. Let's talk about why that's not going to happen using data from the Silver Institute and mining industry forecasts. Global mine supply for 2025 is estimated at approximately 813. That number has been essentially flat for the past 5 years, despite prices rising from 118 to 67. Why? Because silver is primarily a byproduct of other mining operations. About 70% of silver comes from mines that are primarily extracting copper, lead, zinc, or gold. Silver is a secondary product. You can't just open more silver mines in response to price increases because the economics are driven by the primary metal being extracted. Meanwhile, industrial demand for silver in 2025 reached approximately 1 million ounces. Solar panels alone consumed 180 to 90 million ounces. Electronics consumed another 250 million ounces. Electric vehicles, medical applications, water purification, and other industrial uses consume the rest. The industrial demand is growing, not shrinking. Global solar installations are projected to increase by 15% in 2026. Electric vehicle production is projected to grow by every trend in the global economy that matters, renewable energy, electrification, advanced electronics, every single one requires more silver. So if mine supply is 81.3 million ounces and industrial demand is 50 million ounces, that leaves a surplus of 63 million ounces for investment demand, jewelry, coinage, and exchange inventory. But here's the problem. Investment demand in 2025, driven by retail buyers stacking physical silver and institutional money flowing into ETFs, consumed approximately 200 million ounces. That means the market ran a deficit of at least 37 million ounces. And that's before accounting for the fact that some of that supposed surplus never makes it to market because miners are selling directly to industrial users at premium prices rather than feeding exchange warehouses. First, Majestic Silver, one of the largest primary silver producers, publicly stated in 2025 that they're withholding supply from COMEX and selling directly to industrial buyers at premiums of 2 to 3D per ounce over exchange prices. Why would they feed metal into a warehouse system controlled by banks that have manipulated prices downward for years when they can get guaranteed premium prices and delivery schedules directly from manufacturers? The answer is they won't. And without miner cooperation in feeding COMEX warehouses, there's no mechanism to replenish inventory as it depletes. The supply can't save JP Morgan. The inventory mathematics don't work. Industrial demand is removing the surplus that previously cushioned the paper market, and China just cut off the single largest source of supply, right? When demand is hitting all-time highs. So let's talk about where prices go when these mathematical certainties become obvious to everyone. For this, we need to look at historical precedents of short squeeze dynamics combined with the fundamental supply-demand picture. The most relevant historical parallel is the Hunt brothers' silver squeeze of the Hunt brothers, concerned about inflation eroding the dollar's value, accumulated over 200 million ounces of physical silver through purchases and futures contracts. Silver prices skyrocketed from $6 per ounce in 1979 to nearly $50 by January 1980. But the COMEX intervened. They raised margin requirements multiple times in a single week, forcing leveraged players to sell. The Hunt brothers couldn't meet the margin calls and faced a $6 billion loss. Silver crashed from $11 in just 4 months. That event proved two things. First, a concentrated physical position can break the paper market. Second, exchanges will change the rules to protect the shorts. But here's the critical difference between 1980 and today. The Hunt brothers were one family that could be bankrupted by rule changes. Today's delivery pressure comes from Chinese state policy, industrial users who need the metal for production, sovereign wealth funds protecting currency reserves, and thousands of retail investors who learned the lesson of 1980 and know the paper game is rigged. You can bankrupt one billionaire. You can't bankrupt China's Ministry of Commerce. You can't bankrupt a solar panel manufacturer whose billion-dollar production line shuts down without silver delivery. You can't force settlement in cash when international banking regulations now require physical backing for derivatives positions. The COMEX could change margin requirements tomorrow, and it wouldn't matter because the entities demanding delivery aren't using leverage. They're paying in full. They need the metal. So where do prices go? Based on historical squeeze patterns, fundamental supply-demand dynamics, and current market conditions, here are the scenarios with their mathematical basis. Conservative scenario 1 to 12. This is based on the gold to silver ratio returning to its historical average. Gold currently trades around $2,700 per ounce. The historical gold to silver ratio over the past century averages around 40 to 1. Simple division gives you 67. $50 for silver at current gold prices. But if gold continues its own bull market to $4,000, which many analysts expect as central banks diversify away from dollar reserves, then 40 to 1 gives you $100 silver and a 20% premium for supply tightness and physical shortages, and you hit 120. This scenario assumes the paper market survives in some form and ratios eventually normalize. Moderate scenario, 180 to 220. This is equivalent to the 1980 peak price adjusted for inflation. Silver hit $49.45 in January 1980 using CPI inflation data that equals approximately $107 in today's money. The moderate scenario assumes we match that inflation-adjusted peak with an additional premium for the fact that industrial demand is far higher today than it was in 1980. Industrial uses consumed about 20 ounces annually. Today, it's 650 million ounces. Photography, which was the largest industrial use in 1980, has been replaced by solar panels, electronics, and electric vehicles. The industrial demand is structural and growing. It's not going away even if prices spike. So inflation-adjusted peak plus structural demand premium gets you to the $200 range. Vertical spike scenario, $280 to $400 per ounce. This is what happens if industrial supply chains panic and sovereign entities compete for remaining supply. Imagine you're a procurement manager at a major solar panel manufacturer. Your company has a $5 billion production facility that produces 10 watts of solar panels annually. Your entire operation requires 15 million ounces of silver per year. Without silver, your production line stops. Your company faces breach of contract lawsuits from customers. Your stock price crashes, your job is gone. At what price do you stop caring about cost and start panic buying whatever silver is available? $300 per ounce is cheap. If the alternative is missing production targets that cost your company 10 times that amount in lost revenue and destroy reputation. When industrial users compete with sovereign wealth funds, investment demand, and jewelry fabricators, and there's no available inventory because China cut off supply and comics vaults are empty, prices don't rise linearly. They spike vertically. There's precedent for this in other commodity markets. Palladium went from $500 per ounce in 2018 to $3,000 in 2022 when automotive manufacturers couldn't secure supply for catalytic converters. Natural gas in Europe spiked over 600% in 2022 when Russian supply got cut off. Silver has all the same dynamics, critical industrial uses, supply concentration, and geopolitical rivals, and existing short positions that need to cover. The timeline for these scenarios is first quarter to third quarter 2026. Somewhere between 3 and 9 months from right now. That timing is based on current delivery rates, inventory depletion mathematics, China's January 1st export controls taking effect, and the typical duration of stage 2 consolidation and historical squeezes. We're past the accumulation phase. JP Morgan's frantic buying of 750 million ounces proves that we're in the early days of the supply shock phase where the market starts to realize the paper game is ending but hasn't fully priced it in yet. The vertical spike phase happens when registered inventory drops below 10 million ounces and industrial users start competing for whatever's left. The China's export licensing proves extremely restrictive. If the LBMA Cyrillic ban removes as much liquidity as feared, if industrial demand continues accelerating, we could see the spike as early as March or April 2026 if some temporary relief comes from increased recycling, or if JP Morgan manages to negotiate extensions on the ICBC lease, it could extend to August or September. But the mathematical endpoint is the same regardless of minor timing variation. The available supply cannot meet the demand. The paper promises cannot all be honored, and price is the mechanism that rations scarce resources. Now, I want to be very clear about what I'm saying and what I'm not saying. I'm not a financial advisor. I'm not telling you to buy silver. I am not giving you investment advice. What I'm showing you is the mathematics of the situation that is playing out in real time with publicly available data. The inventory numbers are published by COMEX. The delivery demands are documented in exchange reports. The industrial demand projections come from the Silver Institute and mining industry analysts. China's export licensing policy is official MOFCOM announcement. The LBMA rule changes are on their website. JP Morgan's position changes can be inferred from CFTC data and vault inventory movements. This is not prediction. This is calculation based on verifiable information. What I am telling you is that you're watching a mathematical trap close in slow motion. JP Morgan engineered a multi-dead scheme to suppress silver prices through paper manipulation and concentrated short positions. They made billions in trading profits by keeping silver artificially cheap, which benefited Western industrial users and hurt miners in developing countries. They paid $920 million in fines for spoofing, but kept the core manipulation intact. But then the world changed. China decided that silver is a strategic resource for their solar and EV dominance and cut off exports. Basel III international banking regulations required physical backing for derivatives, eliminating the fractional reserve loophole. Industrial demand exploded as the global economy electrified and the price crossed $60, which triggered delivery demands from miners withholding supply, Asian buyers arbitraging price gaps, and industrial users panic buying. Now JP Morgan faces a triple bind. They owe 128 million ounces to ICBC in less than 2 weeks. They can't easily source replacement metal because China controls supply and just shut off exports. And if they pull from their 750 million ounce hoard to cover obligations, they admit that hoard isn't backing their other positions, which triggers more delivery demands from contract holders who realize the backing isn't there. Every ounce they deliver brings them closer to default. Every ounce they refuse to deliver proves the fraud and triggers more delivery demands. The math is unforgiving. 17 paper claims for every physical ounce means only 6% of contract holders need demand delivery to exhaust available inventory. At current delivery rates, that happens in less than 3 months. China's export controls take effect in 10 days. The LBMA Cyrillic ban takes effect in 10 days. Both on January 1st, 2026. And historical squeeze patterns show that when physical scarcity becomes undeniable, prices don't rise gradually. They spike vertically because the entities that need the metal, the solar manufacturers, the electronics producers, the sovereign wealth funds building reserves, they're not price sensitive. They're availability sensitive. They'll pay whatever it takes to secure supply, because the cost of not having silver exceeds any price increase. This is not a conspiracy theory. This is not internet hype. This is mathematics, policy documents, exchange data, and historical precedent converging at a single point. The largest bank in America promised to deliver silver they don't have. The world's largest supplier just cut off exports. The international banking system removed the fractional reserve loophole, and industrial demand is at all-time highs with no substitutes available. JP Morgan can't win and they can't escape, and the clock is counting down. 10 days until China's kill switch activates. 10 days until the LBMA rule change potentially removes hundreds of millions of ounces from tradable inventory. 10 days until we find out whether the paper silver market survives or whether we're about to witness the largest short squeeze in commodity market history. The mathematics is screaming, the policies are documented, the deadline is fixed. And if you're paying attention, if you understand what these numbers mean, you already know how this ends. The only question left is how high silver goes when everyone else figures out what the math has been telling us for months. Because at $67 per ounce, with China cutting supply, JP Morgan trapped in a $22 billion position. They can't exit, and global vaults running on fumes. We're not at the end of the story. We're just getting started. And January 1st, 2026 will be remembered as the day the paper silver market died and physical reality took over. The trap is set, the countdown is running, and there's no escape.